This is Al Brooks, and this is my price action trading course. This module is about the market cycle. The market's in a never-ending cycle, alternating between being in a trend and a trading range, and then a trend again. When it's in a trading range, it can break out in either direction. The trend can be up or down. It does not matter what the direction of the trend was before entering the trading range. Every trend is composed of a breakout phase, which is an initial big trend bar or series of trend bars, and then a channel phase when the market starts to have pullbacks but still contained between a couple of lines. Channels eventually get flatter and broader and become trading ranges. Trading ranges eventually break out. And if you look at any trading range, you can usually see the beginnings of both a bull trend and a bear trend. The market may have a lower high and it may have a higher low. The lower high may be the start of a bear trend. The higher low may be the start of a bull trend. And at some point, the market breaks out and one side wins. Usually, you look for signs of buying or selling pressure within the trading range to get an idea of which side is more likely to win. You can view a trading range as a transition between trends. So you have a trend, the market pauses, hesitates, and then decides what to do, and then it becomes a trend. So the trading range is a transition between trends, but a trend is a transition between trading ranges. There's a trading range, and then the market decides the price is wrong and it has to quickly move to a new price level, a new value level. It might be up and then a new trading range. It might be down and then a new trading range. The trend can be strong, like a breakout, a series of very large bull trend bars, for example, in a bull trend, or it can be weak and contained within a channel, overlapping bars and pullbacks. Trading range can be as small as a single bar pullback, or it can be as large as the entire screen. When a trading range is small and it forms within a trend, it's called a pullback. And when it's a pullback, it's part of the trend. It's a pause in the trend, and you believe that the trend will resume, that the breakout will be in the direction of the trend. When a trading range lasts a long time, 20 bars, 30 bars, 40 bars, it loses its direction. The trend is too far in the past, and the effect that the trend has on the market is too remote. And at that point, the breakout can be in either direction. The trading range means that the trend has lost its influence over the market. The trading range can end up being a continuation pattern leading to a resumption of the trend, or a reversal pattern. In fact, all reversal patterns are related to trading ranges. Head and shoulders tops, for example, are trading ranges. A pullback is simply a small trading range that is a pause in a trend, and you're assuming that the trend will resume, usually within a bar or two, sometimes 20 or more bars. And on a smaller time frame chart, a 1-bar trading range, for example, on a 60-minute chart, could be a 12-bar trading range on a 5-minute chart. Again, if the pullback grows so long that it loses its direction, you look at it and you say, well, I don't know if it's going to break to the upside or the downside. At that point, instead of calling it a pullback, you call it a trading range. And all pullbacks are trading ranges on smaller time frame charts. All trading ranges are pullbacks on higher time frame charts. If you have a trading range that is 36 bars long on a 5-minute chart, it could simply be a 3-bar pullback on a 60-minute chart. This is an example of what I'm talking about. This is the weekly S&P chart. This is the spider. And the green boxes are trading ranges. And I'll look at the first one here. So we have a trading range. We had a bull trend leading up to it, and then a trading range. And the market broke out in the direction of the trend, bull trend, right? So we had a bull breakout. And then within that bull trend, we have another trading range. However, this one broke out in the opposite direction. So sometimes the trading range will break out in the direction of the trend. Other times it'll break out in the opposite direction. Here on the left we had a strong bear trend, and then a trading range, and then a breakout. However, within 3 bars the market reversed. The breakout failed. So the trading range can break out in the direction of the trend, it can break out in the opposite direction, it can break out in one direction and then reverse and go in the other direction. All trends begin with a spike. You can call this single bull trend bar the spike, or you can call this series of bull trend bars a spike. As soon as it begins to have a pullback, it's entering a channel phase, a more two-sided phase. So we have a spike and then a channel, and usually the channel begins with some kind of a pullback. Again, you can view trends as just transitions between trading ranges. Here's a trading range, then a trend, and then another trading range. And you can view trading ranges as transitions between trends. We have a trend, a pause, and then another trend. Channels usually become broader and flatter, and at some point they lose, the pullbacks become so long that they lose their directional predictive ability, and then you look at it and you say, well, I don't know, maybe we're forming a double top bear flag and we're going to break to the downside. We have a low and we have a lower low, we have a lower high. Maybe this is the start of a bear trend. If the market did end up down here, you would look back and say the bear trend began here. So in fact this is part of a bear trend. Here we have a higher low. If the market goes up, you'll look back and say the bull trend began over here. So within this trading range, the market is in a trading range. It's also in a bear trend, beginning of a bear trend, and it's also in the beginning of a bull trend, and that's very common. Trading ranges usually have trends within them, and if you have both a bull and a bear trend, one will end and the other will succeed. Here's another trend. We have a higher low, right? So we have a trend and then a trading range, and we have a higher low and a bull spike. If the market ended up here, you'd say the leg began over here. So this is actually the first leg of a new bull trend. A spike, maybe we have a pullback, maybe we'll get a channel up, right? But spikes don't always succeed. In fact, most breakout attempts fail. Here we have a bull channel, and we tried to break to the downside, and it failed. Here we have a trading range, and we broke to the upside, and it failed. Here's the same chart showing that within every thing that you saw on the prior chart, there are nested patterns. There are smaller versions. So within this channel, there's actually a spike and a smaller channel. Here's a spike. This trading range is also in a channel. On every time frame, the market is both in a trend and in a channel. You can look at any segment of the chart, and if you go to a higher time frame chart, it's something else. So here we have a bull trend, but for a while we had the start of a bear trend. In fact, you could call this a small bear trend. And it's also a trading range. And within every trading range, there will be trends. Here's a small spike and channel. Every part of the chart is always either a trend or a trading range. Every bar is either a trend or a trading range. Here's a 1-bar trend. A doji bar, it's a small body, it's a 1-bar trading range. So everything is either in a trend or a trading range on every time frame, every type of chart. It doesn't matter. You have to understand that this is what the market does, and if you know where you are in the market cycle, you can use trading techniques that are appropriate and give you a better chance of making a profit. So if you're in the spike phase of a trend, once you decide, yeah, this is going up, you have to get long, right? You cannot say, well, maybe I'll wait for a pullback, because sometimes the pullback does not come for a long time. Here's another example. Yes, it's in a trading range, but we're starting to get a series of bull bars, and we broke out of this bear channel. Once you decide that, yeah, I think the market's always in long, you have to get long, because sometimes the pullback does not come for a long time. Once you decide that it's in a trading range, you have to decide, well, it's probably going to go up and down for a long time. I better buy low and sell high, and I better not hold my position for long because it'll come back to my entry price. So if I buy here and hold, it comes back here. So once you decide it's in a trading range, you got to buy low and sell high. You can sell high to take profits on your longs. You can also sell high to go short. And when it comes down again, buy low, sell high. You buy back your shorts to take a profit, and you also might buy to go long. But if you hold, invariably the market will come back to your entry price. So if you bought here and held, it would come back to your entry price, and your profit would disappear. If you sold here and held, it would come back to your entry price and your profit would disappear. So the best way to trade in a trading range is to scalp. Buy low and sell high. Here's a 60-minute chart showing a spike phase, a strong bull trend, followed by a channel phase, a weak bull trend. And channels are usually followed by trading ranges. The channel evolves into a trading range. So we have a bull channel and then more sideways, and the entire screen becomes a trading range. Within the trading range, there's a bear spike, a gap, and a series of bear bars, followed by a channel down. And then there was a bull spike, a series of very strong bull trend bars, and then a broad bull channel. And within each part of the trend, there are smaller elements. There are nested patterns. So within the channel, there's a bear spike going down, here's a bull spike going up, and a channel. A bull spike and a channel. There's a bear spike, and within the channel, there's another bear spike, and then a smaller channel. Why is it important to know about the market cycle and where we are in the market cycle? Because each part of the cycle has different trading opportunities. And if you know where you are in the market cycle, a breakout phase, a channel phase of a bull trend, the approaches that you use to trading are different from those that you would use in a trading range. In general, I try to turn everything into binary decisions. I try to give myself just two choices. When you're trading, you want to think about as few things as possible. And one way to do that is to try to structure your analysis in a way so that every decision only has two possibilities. An example of a binary decision in a bull market is whether the bull trend is a trend within a actual bull trend, or is the rally simply a leg within a trading range. And that's important to distinguish because you trade those two rallies differently. In a bull trend, you're only looking to buy, and you should be swinging at least part of your trade. If it's a bull leg within a trading range, it's good to take the buy signals. However, if there are strong sell signals, especially if there are second entry shorts, you can take those as well. And within a trading range, in general, the focus should be on scalping instead of swinging. In a strong bull trend, that's the breakout phase. I also call it a spike. You need to get long immediately. You should, in general, if it's a bull trend, you should buy at least a small position at the market. A lot of times you look at it and you say, wait a minute, the spike is so big, my stop has to be far, far away. That's right, that's where your stop has to be. But the reward is so large that it's worth it to take at least a small position and use the wide stop. When the trend weakens and it enters a channel phase, if it's a very tight channel, it's essentially it is a breakout on a higher time frame chart. It's a spike on a higher time frame chart, and you should trade it exactly like a breakout. So when a channel is very, very tight and very vertical, very small pullbacks, trade it just like a breakout, a strong bull trend, and only look to buy. If the channel starts to get broader and flatter, less vertical, with bigger swings up and down, you should always make sure to take the buy signals if it's a bull channel. But if the swings are very big and it's basically a trading range that's sloped only slightly up, you can trade in both directions. And in that case, the more it resembles a trading range, the more you should trade it like a trading range. BLSHS, buy low, sell high, and scalp. If the market's going down, also binary decision. It's a bear trend or it's a bear leg within a trading range. And again, you trade them differently. If it's a bear trend, only look to sell and try to swing at least part of the position. On the other hand, if it's a bear leg within a trading range, you definitely should take the sell signals, but if the buy signals are strong enough, especially if there are second entry buys, you can take them as well. And again, if it's a trading range, it's better to be scalping. If the market's in a very strong bear trend, the breakout phase, the spike phase, you need to get short immediately. If you can't figure out how to get short within the next minute or two, sell at least a small position at the market and put your stop at the top of the bear spike. It's a very wide stop most of the time. When that's the case, just trade small and then look to enter more as the trend progresses. If the trend is a weak bear, in other words, if it's in a channel, it depends if the channel is tight or broad. If it's very tight with very small pullbacks and it's very vertical, then trade it exactly like the breakout phase, the strong bear trend, and only look to sell and try to swing. If it's a broad channel, you make sure to take the sell signals because it's still a bear trend. But if the swings are big, trade it like a trading range. Buy low, sell high, scalp, and take trades in both directions. That's the end of this module on the market cycle. Thank you.